Hello everyone, welcome to Oliveboard. I hope you all are fine and doing well. So in today's class we are going to cover some questions from module D. So let's start with the class, and here the first question is in front of you. You can see which of the following is the most consistent with regulatory intent of section 29 of the Banking Regulation Act in the context of financial reporting by the banks. See, if we read the option, you can see here, just a second. If we read the option here, we know that this ALM emphasizes the behavior analysis of liabilities, especially deposits to the differential stable core deposits from volatile funds. This helps banks to assess the liquidity and mismatches more realistically. So mandating uniformity and standardization in the presentation of financial position through the prescribed balance sheet formats is the correct answer here. Which of the following best describes the primary regulatory behind classing bank advances into scheduled, guaranteed and unsecured categories in the financial reporting? See, that section 29 which mandates banks to prepare the standardized financial statement using the prescribed format under the third schedule of the BR Act. This ensures transparency, comparability and regulatory consistency. So here we can say that to enable the calibrated provisioning, capital adequacy assessment and transparency in risk exposure is the correct answer here. Which of the following would not be considered a direct component of bank's cash and balance with RBI under the statutory reporting? See, if we talk about the overnight placements in the money market, they are classified under money at call and short notice, which is a separate subhead from cash and balances with the RBI. So, overnight placement in the interbank call money market is the correct answer here. Now, which of the following item is most appropriately classified under other income in commercial bank profit and loss account? If we talk about the commission on issuing the letter of credit, that is a fee based non-interest income which is categorized under commission, exchange and brokerage. So government securities pay the interest, not the dividend, so it does not belong any either category. So option D is correct. sorry, here we have to see option C is correct, commission earned on issuing the letter of credit. Which among of the following would not be included under interest expended in the profit and loss statement of a commercial bank? If we see the A, B, C options, these are the examples of interest based object outflows and fit under interest expended, which represents the cost of mobilizing the funds. But salary inclusion here would be misstate the bank cost of capital. Now, which of the following is not a part of operating expenses for a commercial bank? Here, which of the following is not a part? See, we know that these operating expenses pertain to recurring day-to-day administrative and infrastructure cost that obviously supports the banking operation. There are provisions for the NPA that falls under provision and the contingencies, which is a non-operating expense involving anticipated future credit losses, which is mandated by the prudential norms. So we can say here option A, option B and option D. These are the typical direct operating outflows. Option C is here the correct answer. Okay. So in the context of asset liability management, which of the following scenario demonstrate a liquidity mismatch risk? See, liquidity liquidity mismatch risk arises when the maturities of the assets and liabilities are not aligned, especially in short-term liabilities, which are used to fund the long-term assets. So in the scenario A, if many depositors are there which withdraw the money at once, so the bank may lack the liquid funds since home loans are illiquid and long tenured. So we can say that lending the long-term home loans using the short-term saving deposit is the correct answer here. So what is reinvestment risk? See, this reinvestment risk means when the cash flows from the assets occur earlier than expected and bank must here uh, like ready to play these funds in a possible less favorable rate environment. In option B, a borrower prepays a long-term loan during a falling interest regime. So we can say that is the best example of reinvestment risk. Now, which of the following poses a refinancing risk and how should it be interpreted? See, Refinancing risk. It occurs when a liability is withdrawn before its contractual maturity, which compels the bank to replace that funding, often an unfavorable cost or duration. So, option B, that is depositor's side to withdraw funds prematurely, we can say this describes an embedded liability like side option and its exercise, which alters the bank liquidity position, compelling that new funding arrangements like triggering refinancing risk. So option B is correct here. So which of the following most accurately reflects the dual objective of ALM at the micro level? Just give 2 minutes. See, here if we talk about the micro level, this ALM is concerned with liquidity management via maturity matching of assets and liabilities, profitability via price matching, which allowing interest income from assets and with the cost of liabilities to maintain the spreads. So option A and B here not correct, but option C is okay, where maintaining the liquidity through maturity, mismatching and ensuring profitability via price matching. Which of the following best illustrates the positive interest rate sensitivity gap and what does it means? See, if we talk about the best illustration, um, that is basically the option B, where rate sensitive analysis are greater than rate sensitive liabilities, which benefits in the rising uh, rate scenario. So which of the following best exemplify the regulatory intention behind the ICAP under pillar 2 of the Basel second framework? See, this ICAP under the pillar 2, it focuses on identifying and capitalizing the risk not adequately captured by pillar 1, such as residual risk or concentration risk. So liquidity and reputational risk here, if banks require to assess and allocate capital for residual, concentration and reputational risk that is not covered under pillar 1, we can say this best exemplifies the regulatory intention. Under the Basel third, which configuration of risk assessment approaches aligns with the increasing complexity and risk sensitivity which is there while maintaining the compliance with the regulatory minima? According to the RBI in the India, first operational, like we can say there is, first we have to do market risk, then credit risk standardized approach, and then standardized duration approach, market risk. So option C is correctly matched here. What is the formula of RWA? There is one formula where we have to multiply it by 12.5. So under the supervisory review process, which is outlined in Pillar 2 of Basel III, which of the following is not traditionally addressed through the ICAP? So in this, ICAP is there under Pillar 2 that captures broad range of risk that are not fully addressed under Pillar 1, like interest market risk, interest rate risk, and reputational risk, payment settlement risk. So the correct answer is here option D. So what is the context of IDQAC, like ICAP? Which of the following action effect by bank would be considered as violation of the principle of proportionality under the Basel III framework? See, principle of proportionality requires larger or more complex banks to adopt more sophisticated ICAP models that even match the size, nature, complexity of their operations. And in this, a large multinational international bank uses a basic spreadsheet model to measure the organizational risk. So that is not good. Here the option is C is option correct. Clear? So which of the following correctly aligns with the SRP principle with the regulatory expectations under Basel III? See, um, principle 1 is saying that bank must to do their own risk assessment. 2 is saying that RBI review the ICAP and ensures banks have to follow that capital rules. Principle 3 is saying that RBI can require more capital than 8% because the risk profile demands. So according to this, the correct answer is option C. Next question. See, in the context of ICAP, for moderately complex bank, which of the following practice reflect a misalignment with the expectations outlined under the Pillar 2 approach? See, we know that there are some basal types of guidelines which clearly mandate regular independent review and the validation of the ICAP. So, assuming the bank's internal models are fully reliable and requiring no validation if historical performance is strong. So the correct answer is option C. There is a small bank, but limited complexity intents are there to implement this ICAP, which is based on its business model. So which of the following combination of activities now best represent as an appropriate proportional approach to ICAP implementation under the Basel framework? So Basel guidelines tells us about the regularity, independent review, and the validation of ICAP. Even the past performance appear robust. So we can say that yes, identification of large historical cases, analysis of the likely recurrence, basic stress, scenario testing, and documented capital planning involves senior management. This thing is the this option is the correct answer definitely here. So which of the following most accurately reflects the forward-looking nature of ICAP under the supervisory framework? Which of the following most accurately reflects the forward-looking nature? If we see the options here, option D is correct. It requires banks to incorporate strategic objectives, anticipated macroeconomic developments, and potential capital constraints in their capital planning. Because ICAP is inherently forward looking, which requires banks to evaluate not just their current capital position but also to project the future needs which are based on. Next question. Which of the following key operational expectation from the ICAP in relation to risk aggregation and the diversification? See, here bank have to document all the assumptions whatever they are used in aggregation and also assess the volatility of the customers, right, which particularly under the stressed conditions. So option C is correct. Which of the following best reflects the RBI expectation from a bank ICAP regarding model based risk assessment? See, here RBI expects complete transparency and rigor in model-based risk assessment. This explains the key assumptions, discussing how factors were calibrated. It starts the model limitation and also showing the sensitivity to those parameters. So the correct answer is there, option C, that is key assumptions, parameter sensitivity, model limitations and validation techniques that must be disclosed for each internal model that is used. In the context of ICAP, which of the following is least consistent with sound sound stress testing practice as prescribed by the RBI? C. Scenario analysis focuses exclusively on the events with likelihood and low severity. So we can say the option A is correct. Which of the following currently identifies the regulatory expectation when assessing the bank resilience under a severe macroeconomic shock as per the ICAP guidelines? See, here RBI expectation that correlation the assumptions whether the intra-risk or inter-risk that must be quantitatively valid, particularly under the stress scenarios where diversification may break down. So under the Basel third framework, which of the following disclosure must be reported at least quarterly by banks as per the RBI guidelines? Quarterly. Capital adequacy as well as general disclosures, and these standardized approach. Other disclosures may be half yearly, but the correct grouping is option B, that needs in every 4 quarters. So according to the pillar 3 requirement, what is the primary rationale for requiring disclosures at the top consolidated level of a banking group? See, disclosures are there at the consolidated level, which ensures that the group presents a clear, transparent financial picture without without double counting the capital or assets, which helps in stakeholders in understanding the overall risk and strength of the group. So the correct answer is option C. So in the context of materiality under pillar 3, which statement best reflect when a bank must disclose a piece of information? See, materiality, that is a judge based or whether not disclosing the information could change or influence the decision of users. It is not based on the internal preference or the market value. So the correct answer is option C, when its omission could influence a user economic decision. So there is a bank that excluded the proprietary and confidential information from Pillar 3 disclosures primarily because see, proprietary information and confidential, these are completely excluded from the loss of competitive advantages and avoid breaching legal confidentiality clauses. So it may harm the competitive position or violate the legal agreements. So the option C is correct here. What is the regulatory purpose of using common template and tables for Pillar 3 disclosures? Pillar 3 disclosures. See, Pillar 3 disclosure, here we can say that to ensure that public disclosures are standardized and they can be compared with anyone at any time. So, in accordance with Pillar 3 disclosure norms, which of the following correctly identifies a scenario where a bank must quantitatively disclose the impact of interest rate in its banking book? See, there is a table that is DF9 which requires banks to quantitatively show that how upward, downward interest rate shocks impacts the earnings or economic value. This is the part of interest rate risk in the banking book, not the trading or not the operational risk. So the correct answer is option C. When management evaluation shows 200 basis point value which shocks the and changes the economic value of equity. So a bank report is there that 18% are additional gross NPA, which is identified the RBI compared to published report. And additional provisioning is 10% over the net profit. So what is the correct Pillar 3 disclosure obligation for this bank? See, as per the RBI 2017 circular, if any condition is here breached, like additional gross NPA are more than 15% or additional provisioning are more than 15%. So we can say that which option is correct in that case? Disclosure required due to NPA divergence exceeding 15%. Which of the following best justifies the national behind recognizing interest income on non-performing asset only on actual receipt basis? Read the option, give the answer. See, under the accrual accounting, income is booked even when it is not received. It applied to the NPA. Banks would show unrealized profit, misguiding the stakeholders. Hence, RBI mandate to actually receive the basis for the NPI to just maintain the transparency. So we can say that it prevents the artificial intelligence of income through accrual based accounting. Which of the following would not qualify as an NPA under the RBI norms, assuming that all payments are overdue? Which of the following would not qualify as an NPA? Mm, Here we can say an account becomes NPA after more than 90 days. So option B is only who have only 85 days. So the correct answer is option B. A bank is there who recognized 50 lakh as accrued interest on a term loan which becomes NPA in March 2025. The interest was recorded in the quarter one of financial year but not received till March 2025. So what accounting treatment is there as per the IRACP? See, reverse 50 lakh from a income or make a provision for it. Like for the RBI norms, interest supply which is booked on the loans that turn the NPA must be reversed or provided for. This applies even if the loan was guaranteed or booked earlier. It ensures that only realized income appears in the bank books. So under the RBI norm, which of the following scenario does not qualify for classifying a working capital facility as an NPA? C. Even though there are no repayments for 95 days and RBI does not classify such type of accounts as NPA just because of no credit unless there are no credit or insufficient credits to cover the interest for 90 plus days. This case does not breach any rule. So, a stock statement is 2 months old, borrower draws 5 lakhs below limit, no repayments are made for 35 days. So, the option B is correct. See, let's see the last question for today. Then I will upload the PDF. Just go through with the PDF for more questions. Only the questions are left, and I try to give the important questions. So just after the class, go through with the PDF. You will get these questions as well as some other new questions. So this question, in a context of positive mark to market value on derivative contract, which means remaining unpaid for 90 days, which of the following statement is most accurate according to the RBI prudential guidelines? there is that's empty and overdue must be reversed from the profit and loss account, and they are tracked under the suspense account until the receipt. So the correct answer is option B. So with this, all of your modules are like almost completed, like all are completed, nothing is left. I will already uploaded the practice sets here. Just go and do the practice, and I hope that you clear your examination. All the very best for your examination. So let's meet on the result day that you are saying that we cleared the exam. So thank you so much. Let's meet in any other place. Till then, take care and have a good day, and just do the practice of all the MCQs. Thank you.